Q4 FY24 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors Limited. Thank you, and over to you, ma'am.
Thanks. Good evening, everyone, and welcome to the Q4 FY24 earnings call of Dixon Technologies India Limited. We have the management today being represented by Mr. Atul Lal, Managing Director and Vice Chairman, and Mr. Saurabh Gupta, CFO. I'll now hand over the floor to Mr. Atul Lal for his initial remarks, post which we'll open up the floor for Q&A. Thank you, and over to you, sir.
Thanks very much, Bhumika. Good evening, ladies and gentlemen. This is Atul Lal, and we have on the call today our CFO, Saurabh Gupta.
Good evening, everybody.
Thank you very much for joining this earning call for the quarter and year ended March 24. Our company has delivered yet another year of strong performance. First, coming to the overall performance for the fourth quarter, consolidated revenues for the quarter ended March 31st, 2024 was 4,675 crores as against 3,007 crores in the same year last year. That's a growth of 52%. Consolidated EBITDA for the quarter was INR 199 crores as against 158 crores in the same period last year, growth of 26%. Consolidated PAT for the quarter was rupees 97 crores against 81 crores in the same period last year, which is a growth of 20%. Coming to overall performance for the fiscal year ended March 24, consolidated revenues for the year ended March 24 was 17,713 crores against 12,198 crores last year, which is a growth of 45%. Consolidated EBITDA for the year is 720 crores against 518 crores last year, which is a growth of 29%. Consolidated PAT is 375 crores against 255 crores, which is growth of 47%. Another highlight for the year was the strong cash generation from operations, which is approximately 584 crores, which was used for funding a capex of 569 crores in the year 23-24. With the strong capital allocation discipline, effective working capital management, and earnings improvement, we were able to expand our ROC and ROE to 38% and 25.2% respectively as on 31st March 24, and further strengthen the balance sheet with gross debt to equity ratio of just 0.09. Working capital days stood at negative of 8 days. Our balance sheet strength enables us to direct growth capital swiftly and enables us to invest in the long-term development of our business. We strongly believe that we have a platform to sustain a strong revenue growth moving forward, addition of new customers across all businesses, including some really large accounts in the mobile business. Now I'll share with you the performance and the strategy in each of our business verticals going forward. Mobiles and EMS business, revenue for the quarter was 3,091 crores. It is a growth of 119% year on year. Operating profit was 105 crores, which is a growth of 78% year on year with an operating profit margin of 3.4%. Revenues for the year were 10,919 crores, a growth of almost 109% year on year. Operating profit in this business was 355 crores, a growth of 130% year on year with an operating profit margin of 3.3%. In the last fiscal, we had already touched a significant milestone of manufacturing 15 million smartphones and 38 million feature phones. Now we have created a capacity of 45 million smartphones and 40 million feature phones. That's approximately 50% of the opportunity pool in this business. We have been making incremental investments in this business in order to meet the increased order book of our customers. We expect a strong growth in the volumes of Motorola smartphones, including a growth in export orders. Our ramp-up in Xiaomi smartphone business is shaping up well. and we'll clock around 3 lakhs per month from May onwards. We're expecting a significant ramp up in the coming months ahead of the festive season. Manufacturing for a global brand through Compal is expected to commence by September 24. The Longcheer as our ODM partner, and we have started manufacturing for Realme, which is the brand of Oppo, and we are clocking around 4.5 lakhs volume in the current month of May, with a substantial uptick in volumes month on month going forward. We expect to add one more large global brands in the coming months. On the ISMU deal, approval of the Competition Commission of India is awaited, and both parties are working on the deliverables for the consummation of transaction. We feel fairly confident that we should start consolidating the financials from Q2 of the current fiscal. Such large order win showcases that practically we are now having all the top 6 brands except for one large global brand as our partners. And this has been a major positive for us in the last fiscal, on which we have to consolidate in the coming quarters. Another important thing which I would like to share with the stakeholders is that in line with the strategy that once we acquire a large scale, the next phase is the deepening of manufacturing. So we are looking to manufacture display modules, and we have already finalized the technology partner. The details will be shared shortly. We are also looking at getting into precision components and mechanicals, and the same is under deep study. So these are going to be the next level, significant steps forward to consolidate our mobile business. Consumer electronics revenues for the quarter were 897 crores, with operating profit and margin of 30 crores and 3.4% respectively. Annual revenues were 4,148 crores with an operating profit and margin of 141 crores and 3.4% respectively. Our first ODM-based mobility solution from 32 inches to 85 inches were rolled out in the current quarter, and we have encouraging response from our customers. Manufacturing and the partnership with Samsung for the Tizen operating system is expected to be rolled out in the current quarter. In addition to interactive flat display panel, we have now started manufacture digital signages solutions from 65 inches to 100 inches. The order book in both these categories look decent. A state-of-art R&D center for display devices has been set up in Noida for superior product developments in televisions and in IFPDs and signages. We are actively exploring manufacturing of industrial, institutional, and automotive displays. Home appliances, the revenues for the quarter was 294 crores with an operating profit of 30 crores, an operating margin of 10.2%, and annual revenues of 1,205 crores. Operating profit for the year is stood at 131 crores, which is a growth of 20% year on year. Mass production has already commenced in our new facility in Dehradun, which has an installed annual capacity now of 2.5 million. In line with the backward integration strategy, our 2 rooms is now fully operational, and a large part of our mold requirement is done in-house. Manufacturing for BSH in semi-automatic category and Panasonic and Lloyd in fully automatic category has already started. Pilot productions for the brands for Reliance in both the categories is completed, and mass production will be starting in the current month. Lighting, the revenues for the quarter were 197 crores with an operating profit of 14 crores. Annual revenues were 787 crores with an operating profit of 59 crores. We have launched professional product floodlight series in Q4 of the last financial year. Further new product introductions in ceiling lights and extension of professional lighting range are planned in Q2 and Q3. We are getting into backward integration for mechanicals, that is injection molding for ceiling lights in Q1 and extrusion for battens in Q2. To achieve better cost optimization for ceiling lights, we are working to expand our product basket by moving to high value and premium products. We have achieved the thresholds for investments and also incremental revenue under the PLI for 23-24. Telecom and networking products, revenues in this segment for the quarter and the year under review were 228 crores and 655 crores respectively. We're adding one more facility in Noida to meet the increased order book from our customers. Mass production is now ongoing for telecom, GPN, ONT routers and Android set-top boxes for Airtel in partnership with various local ODMs. We have started pilot production for Airtel for 5G fixed wireless access devices, and also mass production is expected to commence from June-July current fiscal. We have signed an agreement with Nokia to manufacture 5G fixed wireless devices, and we see an extremely good order book in this particular domain. In this particular category also, we met the thresholds both for PLI investments and revenue. Laptop, tablets and IT hardware products. Dixon, through its 100% subsidiary Padget, is now the beneficiary in IT PLI 2 under the hybrid category. We have committed an investment of 250 crores. We already have now the contracts with Lenovo and Acer. We are targeting to start Lenovo production by September in the current fiscal. Wearables and hearables. Revenues for this segment in the last quarter was 72 crores and 747 crores on the year basis with healthy operating margins. In line with our strategy to deepen the level of manufacturing, we have started the PCB operation and we're looking at injection molding within India. Security services, Dixon share 50% share of revenues for the quarter and the year was 179 crores and 633 crores respectively. The government has come up with a PPO and PR for adding the domestic value addition and also the domestic designing, which as an entity we are pursuing. Rexxam Dixon Electronics Limited, it's a 40/60 JV with Japanese company Rexxam to manufacture inverter controller boards for Dixon. The JV achieved revenues of 94 crores in Q4 and INR 62 crores in 23-24 with extremely healthy margins in a strong ROC. We have a strong order book in this vertical. In this business also we have achieved the thresholds for PLI both for capex and revenues. Refrigerators, we have created a capacity of 1.2 billion direct cool refrigerator, which is more than 10% of Indian requirement under various tier categories from 175 liters to 235 liters. We have started mass production. We have an extremely healthy order book. In the current market itself, we are targeting to produce almost 60K, it is 60% of our production capacity. The season is looking good. We have our anchor customer in Voltas and various other customers and some other large brands we're going to be acquiring and servicing them in the next quarter or so. This is one of the most backwardly integrated and automated plants in the country, and I think our team has done a great job setting up. So I would like to stop here, and Saurabh and I are there to address your questions, please. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditya Bhartia from Investec. Please go ahead.
Hi, good evening, sir.
Hi, Aditya.
Hi, sir. So you spoke about vertical integration in the mobile phones business. It would be great if you could share some more insights into this. What exactly are we planning? What kind of an opportunity would it be? What kind of margins it could entail? Anything that you can share around that?
So the specific component that we are pursuing vigorously, and hopefully we should be able to conclude, is display module for smartphones. We are targeting in phase 1 to create a capacity of almost 25 million in the Delhi NCR region. We are almost at the closure of a technology partnership and possibly deeper partnership with a technology provider. So we are putting the resources in place. The capex in this is going to be almost $30 million without land and building. and it's going to be a relatively higher margin business. And so that is the contour. The exact numbers are still being finalized, but I'm just giving you the basic idea.
And this will likely be in a JV kind of a form. And does that also mean that we are incrementally becoming more open and more excited towards getting into the component ecosystem?
Oh, yeah, absolutely. Absolutely.
Sure. In the last conference call, sir, you had also referred to the opportunity on the PCB assembly side with one of the large global customers from whom you had received RFQ. Any details that you can share around that?
So that is what we are pursuing. We are going to be setting up a new campus, in which the non-consumer side of PCB is going to be housed in Chennai. That RFQ is being pursued, and we are very, very optimistic that we're going to secure the business.
Understood. Sure, sir. And so my last question is on the kind of acquisition that we did with iSmartU. Do you think this kind of an acquisition could pave way for more such deals, especially with customers who have their own manufacturing facilities?
So I think iSmartU is extremely positive strategic acquisition for us, and it's a larger relationship which goes for years and years. We are pursuing those kind of relationships at present, but we are pursuing vigorously. Let's see where we reach, but we'll keep updating you, as and when we have significant, tangible developments there. But we are going to be pursuing.
Sure. Thank you so much, sir. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Ankur Sharma from HDFC Life. Please go ahead.
Hi, sir. Good evening. Thanks as always for your time. First question on the cell phone segment. Slightly softer revenues this quarter, but I'm assuming things will start ramping up over the next few quarters. I think you mentioned you have about 45 million smartphone capacity is what you created. By when do you think you can actually fully utilize it? Is it like a 2-year, 3-year time frame by when you think you can actually fully utilize that capacity?
So Ankur, the ramp up is happening. To share with you in the current month itself, and here I'm talking about without iSmartU, we are at a level in the current month of approximately 1.5, 1.6 billion. And if I add the iSmartU volumes, that's another 0.7, 0.8.
Mm-hmm.
So we are already at 2.3 million a month, right? And we will keep improving. So, let's see. I feel that this year itself, we should be somewhere around 28 to 30 million.
I'm sorry, 20 million you said, sir?
Sorry?
Around 28 to 30 million, excluding Samsung.
Samsung, I'm not including Samsung display.
Sure.
Samsung would be another 10 million. But right. Without Samsung, we should be at somewhere around 28 million.
28 million. Got that. Sorry. Okay. My bad. Okay. Perfect. Okay. And if you could also just share the volume numbers, the annual volume numbers for your categories, TV, washing machine, lighting, so on and so forth.
Yeah, sure. Okay. Just give me a minute.
Yeah.
Yeah. So I'm sharing you the annual numbers.
Yeah.
So on LED TVs, our volumes was around 3 million.
Mm-hmm.
LED bulbs, so volume was 94 million.
Mm-hmm.
Patterns, 20 million. Downlighters, 2.5 million.
Mm-hmm.
And other lighting products, which is other products which don't fall in the above SKUs, is 17 million.
Okay.
And then semi-automatic washing machine was 1.7 million.
Mm-hmm.
Fully automatic washing machine was 1.6 lakhs. 0.16 million.
Mm-hmm.
Smartphones, excluding Samsung, was around 6.5 million.
Okay.
Feature phone was 38 million.
Okay.
Samsung smartphone was around 8.6 million. And yes, so yeah, pretty much, these are the numbers. You want it for security surveillance and all other products?
No, that's okay. I think this is great. I think that's also my side. Yeah, thanks. All the best.
Thank you.
Thank you. The next question is from the line of Deepak Krishnan from Kotak Institutional Equities. Please go ahead.
So maybe just one first to start off, just a bookkeeping question. Anything in other income that you see is in a sharp?
So may I request you to use your handset, sir? Your audio is slightly muffled.
Yeah, is this better now?
Yes, sir. Please go ahead.
Yeah, maybe just a bookkeeping question first. Anything in other income that you've seen a sharp jump this quarter? Anything that sort of is one-off or any PLI or anything that is booked over there?
No, so basically this, Deepak, this includes, we have got a large FX income in this quarter, foreign exchange gain of almost 10 odd crores, and then 7 to 8 crores is some of the liabilities which have been written back. But majorly it's on account of the FX income.
And the PLI income booked in revenue this year for the full year versus what was it for last year?
Yeah, so PLI income for the full year it was around 71 odd crores across four PLIs, excluding IT hardware.
Sure, and the corresponding number would be closer to 9 crores last year, if I remember correctly.
Last year it was a number of around 10 to 11 odd crores.
Sure. So maybe just on smartphones, given that we sort of have this tie-up with Longshare as well, how are we looking at, the ability to add further customers? I think you sort of indicated one large customer is the potential, but in terms of, and further just for the year, how are we looking at the overall ramp-up? Because you've given a number of closer to 30 million smartphones. But if I look at, is the ramp-up already from the beginning of the year, or should we assume that iSmart 2 comes in and that's a larger kicker that kind of comes through from 2Q?
So as I shared with you, Ankur, please appreciate that we have now top 6 brands except for one large global brand in our customer portfolio. And one more large global brand we're going to be adding in next 3 to 4 months. So practically we have all the brands dominating in the Indian mobile scene. And we are ramping up. Ramp up takes some time, but we feel confident that quarter this volume will keep on increasing. And definitely what you're saying is absolutely apt that the Transsion numbers, the iSmart 2 numbers, is going to be an extremely important kicker in this.
Sure, sir. Those were my questions, and best of luck for future quarters.
Thank you. The next question is from the line of Girish from MS. Please go ahead.
Thanks for the opportunity. I had a couple of questions. So when I look at consolidated cash flow for the full year, we were at 726 crores last year, and this year we were at 584 crores post-tax. Can you explain, because your net working capital is minus 8 days for the 3 line items, so what exactly has led to a reduction in cash flow from operations?
Yeah, so basically last year if you look at the cash flow, there was a 275 crore working capital positive change for us, which got generated mainly on account of the good work done on the lighting business, where our working capital intensity in a year prior to last year went up high. So we got a lot of money released in the working capital in the lighting business and also in the mobile business. Because initially, those were initial years in mobile business, and initially, whenever a new business starts, working capital gets stuck, which we were able to correct in the last financial year. So that 726, broadly, you should attribute it to, out of that 276 crores coming from working capital broadly. So if I exclude that 276 crores, we are talking about 450 crores of cash flow, which got generated last year. That 450 crores has actually gone up to 580 crores, because this year there is no working capital generation. There is a small 9 crores negative working capital. So broadly, that's how you should look at it.
And sort of, I also see a increase in payables of 1621 crores. That is offsetting the receivables and other financial assets and inventory, etc., receivables and all of that. So is this the way it will be now going forward, that the payables will continue to increase at the same pace at which receivables, and because how fragmented is this payable basket? Is it concentrated? How is it like? Can you probably provide some color around sustainability of these payable days?
Yeah, so this is sustainable because clearly large part of this payments is attributable to our mobile business. So if you see the whole revenue breakup, 62% of our revenues are coming from mobile business. And we have two business models, OEM business model and ODM business model. In a prescriptive business or OEM business model, clearly there is an understanding that when the customer, we will pay to the vendors only when the customer pays us. So there is a negative working capital. So for every receivable that you see, there will be correspondingly payable which is there. And that's the whole reason why both receivable and payable are looking on a higher side. It's mainly attributable to the mobile business, and also what our team has done, that increasingly on account of better scale, size, our teams keep negotiating with the vendors and get the creditor days pushed, get better credit days from the vendors. So, but majorly it's largely attributable to the prescriptive part of the business, and also being prescriptive, it's attributable to the mobile business.
And business model has been defined like this, that the deployment in the current asset should be absolutely minimal.
Okay, my second question was on capex. So we incurred net 569 crores this year. So what are we penciling in this year, given that we have some expenditure on display also going in? And if you can provide some high-level breakup of that capex for fiscal 25-26.
So, Girish, the numbers are being worked out, but clearly one of the numbers which Mr. Lal also mentioned in his remarks is that $30 million on the mobile display. This in itself is 240 odd crores. Then there are certain committed capexes under the PLI, under the lighting components PLI, under the IT hardware PLI that we have to do, and also on the inverter controller board where we have a JV with Dixon, some part of capex. So our first impression is, I think so broadly I'll have that numbers in the next 7-10 days, but broadly if on the opportunities that exist today, I think so it should be lower than the current financial year of 570 odd crores. But yeah, things are dynamic and lot of opportunities are coming to us. So, but as of now, we believe that it should be lower than this 570 odd crores.
Yeah, because a lot of capex in mobiles has already been front-ended. A large part of our capex last year happened on refrigerators and washing machines. So those capacities have already been created. So some balancing capex more has to be done, but large part of capex has already been front-ended. New capex will happen only in some new projects and some PLI commitments.
Okay, let me ask, on the land side, have you incurred any number, can you share in FY24, and is there any land capex that is required to be done in 25-26? If you have any estimate on that.
See, 2 land parcels that we bought, one for a mobile plant where the construction is happening. We are creating almost 1 million square facility there. So that land payments have been done there, and also the refrigerator plant is now operational. So the other large land parcel was also the refrigerator plant, where both the payments. So the only investment that we foresee can be in Chennai, where either we can go and take a lease model there, go on a rented premises for our EMS business, which also was mentioned by Mr. Lal, or otherwise, yeah, we can potentially buy some land and construct it. But as of now, those things are not final. But most of the other things have already come into the system.
Okay. And the customer acquisition on the margins for mobile side, outside of this display, obviously they are prescriptive, so you have been running at 3.4, 3.5, including the PLI. But the new acquisitions that have come through on customer side, are they margin accretive? And if you can qualitatively say, like, how will the mixed margin for mobile segment look for FY25?
Yeah, so I can clearly say that those new customers are definitely margin accretive as compared to our earlier anchor customer. And also, secondly, if you look at once you get an operating leverage into the system, you generate that extra margin. So there is a clearly operating leverage benefits which come in. And as mentioned, we're also now looking into the backward integration of mobile display, and also at some point of time getting into the precision components and mechanicals. So both of them will also add to the margins.
And sorry, last question on lighting margin. We used to have, close to 8 to 9% margin. Now the margins have trended down a little bit for last couple of quarters. I understand the devaluation aspect on the revenue. What I wanted to understand was that with the PLI benefits also flowing through, is there any one-off in the second half this year on lighting margins, or are these likely to sustain going into next year?
Yeah, so please appreciate, Girish, there's always a element of fixed cost in any business. So when the volumes fall or when the revenues fall, but you need a certain level of minimum fixed expenses to run those operations. So that is majorly attributable for the margin fall that has happened in the lighting business here.
Okay, understood. Thanks and wish you all the best.
Thank you. The next question is from the line of Mayur Patel from 360 ONE Asset. Please go ahead.
Yeah, thanks for the opportunity.
Sorry to interrupt, sir. May I request you to use your handset, sir? Your audio is muffled.
Am I audible?
Yes, sir. Please go ahead.
Yeah, thanks for the opportunity. While the company remains on a very strong growth path driven by mobile phones, but on the other segments like consumer electronics and lighting, we saw 9.9% decline and around 27% year-on-year decline. Just if you can share some thoughts around how do we see where this can settle in terms of bottoming out and start to grow. That's question number one, and then I'll ask the second question. Thanks.
Please appreciate. Let's first talk about the television business. In television business, as far as the outsourcing opportunity is concerned, we have almost 60 to 65% market share. So that opportunity pool is not growing. That is the reason one is leading to this kind of a situation. So what are we doing to address that issue? We're basically doing three things. One is going in for backward integration. So we have already invested in the injection molding plant, and the mechanicals for televisions are happening in-house now. We should add to our margins. We have also started the manufacturing of LED bars, which should add to our margins. The second step we have taken is to migrate more and more to JDM and ODM. So contribution of JDM ODM is increasing, and we have successfully launched the Google solution, and now the tiling solution is also be launched in this fiscal, which we should be able to acquire more customers, and it's more margin accretive. The third thing is that within the same infrastructure with the balancing capex, we enhance and expand the product portfolio. So that's what we have done by launching first the IFPD, that is the interactive flat panel displays. The production is already started for some large global brand, and we will keep on expanding. And the second is to get into digital signages. So that's what we are working upon. And please also appreciate that in this particular space, we're 4 to 5x of our next in competition. And we're fairly confident that we'll hold on to that pole position. So that's where it is. In lighting, the industry has gone through significant distress. So what are we doing? One, we are trying to build up a larger product portfolio. We have entered into the professional lighting. The floodlights and the panel lights have already been launched. The street lights are going to be shortly launched. Further, we have got into our own toolings of downlighters. We have also set up an infrastructure for extrusions for battens. This should make and build in more comparative strength into the company. Third, we are also looking at some new customer acquisition, and we've been successful. Now we have some large anchor relationships with some large brands in India who have moved out of insourcing to outsourcing, and we are going to be their anchor suppliers. So these are some steps taken, and internally we have also restructured the organization. So I see an improvement in the order book in the current quarter. Hopefully, it should keep improving. I think it's going to take a couple of quarters more.
Sure. So, is it fair to assume that, going forward, at least you'll be flattish to get into some positive growth trajectory in these two businesses?
I'm not able to hear you. The voice is not clear.
Is it fair to assume that this decline would be arrested in a quarter or two and we would be in a positive growth trajectory in these two businesses?
Yeah, I feel that in lighting, the growth will happen and the numbers are going to be better from the current quarter itself. And in television, I feel that from the second part of Q2, the numbers should start getting better.
Sure, sir. So just one more question, if you may allow me. We have delivered very robust growth across top line, EBITDA and PBT. But for the year, the operating cash, sorry if you have already answered this, I joined a bit late. Operating cash generation has declined year on year. And this increase is it because of working capital and is it temporary in nature because of the ramp up in mobile phone, or is it structural, any change in the working capital structure, working capital days cycle?
As Saurabh was explaining, in 22-23, we corrected the working capital situation because that time it was in ramp up, the mobile phone business was in ramp up phase. And we had invested a lot of capital in our Motorola business and also in our lighting business. So we corrected that working capital, and by that we generated almost 276 odd crores. So working capital today, please see the operating cycle today is negative 8 days, is almost at an optimal level. So there was no more scope of improving the working capital situation. And so if you remove the 276 odd crores, in 22-23, the cash generation was approximately 450 crores. And in this year, I think, Saurabh, it's 580 odd crores. So the cash generation from operations this year is higher than 22-23.
Sure. So you think the negative working capital cycle can be sustained in this mobile ramp up trajectory?
We feel so. We see in the company we have a huge focus on our operating cycle, on our current assets. Day in, day out, the teams work on it. So there can be some challenges in near term, for a quarter or so, when some new customer acquisition, because it takes time to stabilize. But on an overall basis, there will be no dilution of this focus.
Sure. Thank you very much. I'll get back join the queue.
Thank you. The next question is from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity and congrats for a good setup. So generally, after the Q4...
Sorry to interrupt you, sir. There's a slight disturbance from your line. May I request you to please use your handset?
Yeah, I'm using handset. So just generally you give guidance about the next year at the Q4 quarter. So any guidance in terms of revenue growth for FY?
The line is not clear, sir. There's a lot of disturbance from your line, sir.
Is it okay now?
Yes, sir. You can go ahead.
Yeah. So, sir, just the guidance for FY25 in terms of revenues as well as margin. If you can share, please, at the console level. Yeah, thanks.
So we are not been giving guidance now. So we are not in a position to share the numbers and guidance at this stage. But please be rest assured the growth is going to be robust. A new customer acquisition has taken place. The new verticals have a very decent order book. So we are confident about our growth numbers.
So, obviously, yes, but any ballpark figure that you would like to share, like, let's say 30%, 40%, or any range if you can at least guide, because there are too many moving parts, and in a way the guidance would be much more helpful to the entire investor and analyst community also, and also on the EBITDA margin. Yeah, just a kind request. Yeah, thanks.
I can't give the growth forecast, but what I'm reiterating is that the growth is going to be extremely healthy, very good.
So Anirudh, on the EBITDA margins, you can assume a similar level of some 4%, because a large part of our growth will come from mobiles, which is relatively a low margin business. Of course, the margin levers for us will be operating leverage, more backward integration, and designing wherever possible. But yeah, so margin-wise, you should assume the same level what we have achieved this year. But we would refrain from giving any guidance.
Okay, sure, sir, sure. Yeah, thank you. Thanks a lot.
Thank you. The next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Yeah, so thank you for taking my questions. So a couple of them. So first one, I want to just understand, predictability of our mobile phone revenue, because while we've been winning a lot of orders, even on a QOQ basis, our revenue hasn't grown. Now you've spoken about, few numbers, not guidance, but effectively, how many million you expect to do. How predictable is it? Is the customer going to decide it 2 months ahead of schedule whether you make it, or is this sort of carved in stone that the 27, 28 million you spoke about is something we should be able to do next year? That's my question number one.
So Pulkit, how does it work? We are an extended arm of the principal. We have to create capacities for them. As per their internal business plan, they ask us to create capacity. They give a quarterly breakup of their expected requirements. Now, is that cast in stone? No. Can there be a variability to it? Yes. But largely, what they share, it's broadly in that range. There can be a variability of 10 to 15%. So that's one aspect of it. The second aspect of it, please appreciate that what are we trying to do? Last year, our smartphone numbers were 6.5 million. Including iSmarty, we're talking about 28 to 30 million. Now, these are new customers, complex SKUs, complex models, NPIs, launch plans. The ramp-ups can get delayed. So that can have an impact. And that's how it is.
Understood, sir. So that's very clear.
And Pulkit, also to add to it, I think so one of the reasons why our Q4 numbers are also lower is because of the ramp down of the Jio Bharat 4G business. And the ramp up of the other businesses, the customer acquisition has taken some time. But now we feel confident with the numbers that we mentioned, and we also gave you a visibility of the current month numbers. So we feel more confident and in the numbers that we have just mentioned to you on the annual numbers or the monthly numbers. Now, there can be delays of a couple of months here and there, but broadly we feel more confident. We have had deep discussions with the customers. We have made those capacities for them. We have done those capexes for them. A lot of models have already been approved. So we feel more confident about the...
Or anything can happen. For example, let's say consolidation of iSmarty. Now, the final approval is lying with ECI. There can be a couple of weeks delay. So that might have an impact. Now, those kind of situations. Okay?
Sure, sir. No, and I think the good thing is that at least the year has started off well in terms of general mobile phone shipment. So my second question is again related to the margin bit. Now, obviously, we've created so much capacity in the last 12 months on the smartphone side. I would have guessed there would be some part of that capacity which in FY25 should have given us better operating leverage as we ramp up volumes. So I'm just trying to understand, is the margin number you're giving a bit on the conservative side, or the contracts are negotiated in such a way that 4% or sub 4% is the number that we should keep in mind? Just trying to understand that aspect again a little better.
So let me share with you the new customer acquisitions are better margins. So let's see how it emerges, because there are so many customers, so many SKUs that on blended basis how it evolves. So that's the number that Saurabh has given you on the basis of his internal calculations. But the new customer acquisitions are margin accretive.
Yes, Pulkit, you will see definitely we feel there will be an improvement in margins in our mobile business from the earlier years. So even if you look at this year also. Of course, this mobile and EMS factors into account the margins of other businesses. So mobile business margins are slightly lower than the 3.3% that we have shown for the combined category mobile and EMS. So please be rest assured those numbers of mobile business margins would actually grow this year. And clearly, the point that you had mentioned, the capacities, larger scale, benefit of operating leverage would kick in. And some of the better commercials that we have for the new customers that we have got on board.
Sure, sir. Thank you.
Thank you. The next question is from the line of Nikhil Agrawal from VT Capital. Please go ahead.
Good evening, sir, and thank you for the opportunity. So as you said, our mobile business margins would improve, and the newer customer acquisitions are more margin accretive. But since Compal is one of the acquisitions that we did, they are also contract manufacturers themselves. So I did not really understand, like, are the margins for Compal on a higher side, or I mean, if you could just throw some light on that.
Gives the customer-wise breakup. So I'll not be able to share those kind of details, please.
But more so, our point was not specifically referring to Compal. It was more referring to the other acquisitions that we have had.
Okay. So, but our margins for Compal would be slightly on the lower side compared to your average mobile.
Let's not get into those kind of.
Won't share any customer-specific margin profile. Overall, yeah, broadly we have given you a direction where the margins can be.
Okay. And so if you could just repeat your LED TV volumes for Q4.
3 million. Q4. Okay. You wanted of Q4. Annual volumes of 3 million.
For
Q4 it was 6.5 lakhs.
Okay. And so your open cell prices fell down quarter on quarter in Q4?
Sorry?
Did the open cell prices fall down further in Q4?
No,
open cell prices are increasing.
They are on an upward trend, open cell prices. So that's why the drop in volumes is more as compared to the overall revenue drop.
Okay. Understood, sir. That's it from me. Thank you.
Thank you. The next question is from the line of Keyur Pandya from ICICI Prudential Life Insurance. Please go ahead with your question.
Thank you. Congratulations to the team for a good set of results. Sir, first question is on mobile side. So you mentioned about 28 to 30 million kind of smartphone volumes. If you can just break it up into from this current level of 0.3 million for Xiaomi, 0.4 million for Realme. What kind of peak revenue we should see, say, in FY25 or FY26, till whatever time you have the visibility? The way you mentioned last year that 0.5 million for Xiaomi, that is what the visibility we have.
Yeah, so that's the visibility we have. And when we put in together the numbers of Motorola, Xiaomi, Realme, iSmartu brands, that's Techno, Itel, Infinix. The new brand that we are in the process of acquiring, and also Compal. Yeah, we should be hitting on a consistent basis after the ramp up has stabilized, somewhere around 2.2, 2.3 million a month.
That is in FY25 itself, right?
That's right.
Okay. Second, now with a lot of brands at various price points, what would be our average realization for smartphone?
So now it's averaging somewhere between 8 to 9,000.
Okay, understood. So thanks a lot. I will get back in with you. All the best.
Thank you. The next question is from the line of Ruchita Kadge from iWealth. Please go ahead.
Hello, sir. Good evening. So my question was regarding the partnership that we've had with Dassault. So just wanted to understand a little bit about that, like what kind of benefits that we'll be getting through this, and what is the additional cost that we'll be spending?
So See, manufacturing execution systems, MES, is an extremely important tool. It gives us the real-time data and also automation on our manufacturing lines to improve the production efficiency. So Dassault is a global conglomerate which has a lot of strength in this tool. We have partnered with Dassault to launch Dassault platform MES to start with in our mobile plants, the Motorola plant and also the other plants. And this tool will be used for mobile production and also for our IT products production. So the total capex or a total spend on this Dassault would be somewhere in the range of around 7 to 8 crores.
Yeah, 7 to 8.
Okay. So this will lead to how much cost benefit for us?
Well, the cost benefit, we have not put in a number like that, but this is an extremely important tool for enhancing the productivity, for getting the yields right, for reducing the rejection level, for getting the data points to analyze on the quality, on productivity, on manpower efficiency. Yeah, so this is an extremely important tool which globally all the major electronics manufacturers, not only electronics manufacturers, across the whole manufacturing industry they use. So we had the first partner in Siemens. So our Siemens MES platform has been rolled out in a TV plant and a fully automatic top loading plant. For our production of Xiaomi and Realme, we're using Longcheer as MES. For our other products, we're using Dassault.
Okay. Understood, sir. Thank you.
Thank you. The next question is from the line of Abhishek from DSP. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. So just two questions from my side. First is, sir, in terms of some of the other initiatives that you have spoken about in terms of the EMS capability, the EV thing that you wanted to get into, any kind of breakthrough there or any traction on those segments?
We are talking about the other EMS space, right?
Yes, sir. So the PCBAs and the other opportunity that you had kind of articulated in your earlier calls that you want to get in there, any kind of incremental traction on those segments?
So in my response to Aditya's question, I already explained in detail that we are very optimistic of securing some large contract in the industrial EMS space from a global player. I also shared that we are setting up a campus down south in Chennai, where this is going to be housed. We are in discussions in automotive electronics space and also the industrial electronics space. But can I put in a number to it? At present, it's in a very, very formative stage. So are we going to pursue this aggressively? Yes, we're going to pursue. But can I put in numbers and budget to it? No, it's too early.
Sure. We should see something in FY26, some contribution coming in from there. That's the way one should look at it.
Next fiscal, yes. Current fiscal, to put a number to it is difficult.
Fair enough. So the other thing is in export of lighting, any kind of breakthrough there. That's something we've been pursuing for a long time. So how should one look at that segment?
So we are exporting. We are exporting to Middle East. We are also exporting to Europe. We are working on some contracts in US. But we are still waiting for that significant breakthrough. I know that I've been talking about it, but to be very candid, I'm still waiting for that breakthrough.
Okay, so wish you all the best for that. So just one other thing, now that you've spoken about trying to deepening the overall manufacture process and where you are spending in mobile phones about $30 million, how should one look at the return on capital on these incremental investments? Will it be very similar to what you have been doing, or will it be slightly dilutive? Any sense around that?
So the ROC is going to be high, the margin profile is going to be better, It's going to enhance our stickiness with our customer. It's going to be margin accretive. Yeah, it looks good, at least as of now. Yeah.
Oh, okay, sir. Thank you so much, and wish you all the best. Thank you so much.
Thank you. The next question is from the line of Yash from Stallion. Please go ahead.
Hi. Thank you for the opportunity. Am I audible?
Yes, sir. Please go ahead.
Yeah. Thank you. So I just want to understand that since you've increased the capacity in your smartphone from 30 million to 45 million, what is the sort of the utilization level you're looking at broadly on average in FY25?
So we feel that we should be, so the capacity is around 40 million. We should touch around 28 to 30 million. That's what we are budgeting.
Okay, got it. And I just wanted to confirm the blended realization number per smartphone. Is it average about 8,500?
Yeah, somewhere between 8 to 9,000. Yeah.
Okay, got it. And so just one thing. So in your Q4 results, I see a big jump in other expenses. It went up 81% Y-on-Y. I think it's about 170 crores. So I just want to understand what are the components there and why there was such a sharp jump?
Yeah. So this is basically the ramp up that has happened in the mobile business, where you all basically have people on board on the contractor side, on the wages side, and currently initially the utilization levels are lower, but yeah, on the salary costs, on the consumables, whenever new businesses comes, NPI happens, those costs increases.
It's basically the ramp up cost. When you're inducting a new principal and a new SKU, it takes time to reach the optimal level of efficiency, and that leads to the higher cost. Which once you reach the optimum level of efficiency, it normalizes. That's the reason for this increase in expenses. And so many customer acquisitions and so many launches have happened around the pipeline that has led to this.
Got it. And so just one last thing. The realization number that you mentioned is net of GST?
Yeah, net of GST.
Okay, got it. Thank you.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, thank you for the opportunity. Couple of questions. Can you highlight what was the mobile phone export number for FY23, and of the 28 to 30 million overall sales that we are going to do next year, what proportion can be exports?
So the export number was
1,250 odd crores. So broadly, basically for an anchor customer only to North America market. So the volume number would be somewhere around 1.25 million for this for 23-24. Now for 24-25,
well, we are still working on the contracts of export, but my sense is that this should be around 60 to 70% growth from this.
Sure, this is helpful. Second, on the laptop manufacturing part, right? So if I recall correctly, we earlier guided for tablets in April and laptops in September or somewhere around. Do those timelines still hold, or the tablets are moved back to September as well?
So tablet production, commercial production has still to start. The trials have happened. And the laptop production is targeted for our large principal from September. It's still the same.
So any ballpark revenue that we are targeting, maybe if not for 1 year, in the next 3 years, cumulative revenue that we are targeting in this segment?
I think let's wait for some time. It's still in the formative stages.
All right. And last one, if I may. So in this PLI for IT hardware, the government has put a lot of emphasis on localization of components. So is there something that you are exploring over there as well, in-house component manufacturing, or those will be done by domestic manufacturers but not yourself?
So part of it is going to be done in-house, and a part of this is going to be with the local partners in India. So when we are looking at display module is also going to be for notebook and tablets.
So display will be extended with that technology partner on for notebooks as well.
Sure. That's all from my side. Thank you so much.
Thank you. The next question is from the line of Onkar Kugardari from Sri Investments. Please go ahead.
Yeah, hello. Am I audible?
Yes, sir. Please go ahead.
Yeah, my question was regarding now you are venturing into so many new ventures. What kind of capital expenditure you would be doing, and any need for requirement of capital for that? As you have already mentioned, if need arises, we will go for it. That's the first question.
To answer the second question first, I think so. For the capex requirements, we have now reached a stage whereby we don't need any capex funding. It will be funded completely from the internal accruals, from the earnings of the company. And capex number is concerned for this financial year. All I can say right now is it should be lower than the 570 crores that we did in 23-24. So we are working out those numbers, but it should be lower than that number.
Any equity capital?
May I request that you use your handset, sir? You're not clearly audible, sir, on the platform.
Yeah, am I audible now?
Yes, sir. Please go ahead.
So as of now, we don't see a reason to raise any equity.
Okay, all right. The second question is on you had said that you would be refraining from giving any guidance, but directionally, where can we see the revenue headed? Like I say, next 3-4 years, so many opportunities.
See, we are